Hey there, I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. You're getting a background view right now of the setup. Let's go to camera two. Thank you so much for joining me. This is my live stream. It's called Be the Boss of Your Money. It's all about personal finance. It's called Be the Boss of Your Money because I want you to take control of your money. That's what the show is all about. I put my over 30 years of experience as a financial advisor to work for you so I can share with you tips, tricks, and lessons that I've picked up along the way, either for myself, for my clients, and I share them with you so that you could really take control of your money. That's what it's all about. I thank you for tuning in, checking it out. Your time is very valuable, and I greatly appreciate that you chose to spend some of it with me. It's the bulls versus the bears. I can give you so many reasons why this market will keep going higher. I can give you so many reasons why this market will go lower. We have to talk about this and see which one wins, test your comfort level, your risk tolerance, and pick a direction. That's what we need to do, and that's what this show is all about. So, having said all that, let's take it to the quick intro, and then we're going to get into it. It's going to be a good show. And we're back. Thank you so much for joining me. My name is Mitch Goldberg. You're watching Be the Boss of Your Money, my live stream all about personal finance so that you could take control of your money and make your life better. Isn't that what it's all about? Today's show is about the Bulls versus the Bears. I want to go over a couple of things, do a little bit of a gut check, and I want to catch up on a couple of things. Just make sure we're all caught up on where the market is, what it's doing, and what you need to know going forward. And then, of course, we add the personal finance education in every bite. Okay, so if you have any questions, hit me up in the comments. I love answering your questions, whether or not you're watching in the live stream or the replay. Welcome. Thanks so much for joining me. What I'd love to see you do is ask questions. If you have any words of wisdom, that's always appreciated in the comments as well. And if there's a topic that you want me to go over, the comments. That's where the action is. It's all in the comments. So we'll first take a quick view of how the market did today. We're going to catch up. In particular, I want to point out small cap stocks and the volatility index. And then we're going to move on over to crypto. All right. Check out how crypto does. I haven't done a show without talking about crypto in ages. It's just a part of the market, and I think it's something that people should know about, and I'll tell you why in a moment. There's a number of reasons. We've got a couple of soothsayers out there who are predicting big things for certain sectors, in particular Tom Lee of Fundstrat sees a huge rally coming up for oil stocks, and then we're going to take a look at how some of the sectors did and how the FANG stocks did. Okay, so here we go, and then we're going to talk about some of the bullish and bearish things, and we're going to do this quick. So let's do a quick share screen. Okay, I'll put myself up in the corner over here. Here I am, okay? And while you're watching this, don't be bashful. Give it a thumbs up, a heart, little love reaction. I know that sounded really cheesy, but my wife is watching and she gave me a heart. So I can say I got a little love reaction. Thank you, babe. So we're going to get into a couple of things here. I made the screen a little bigger, so hopefully you could see it. But if you see here the Dow, okay, so we finally had a down day after 3 straight weeks of a bullish up market, 4 weeks in a row actually. But a number of records were hit last week and the week before. We finished out last week with record highs. So I don't think it's anything overly frightening or horrible to have a little bit of a give back, okay? But is it more than a give back? We have to talk about that. All right. So the Dow is down, 1/3%. NASDAQ off slightly less than 1%. S&P off 0.5%. I mean, these aren't horrible numbers given the rally we've had. Gold off a little bit. Gold has had a nice rally though recently. Oil continues to hang out there at around $63 per barrel. Went to like 66, down to like high 50s for a very brief time. And it's been hitting, around low 60s ever since. The 10-year treasury, everybody was so scared when it went above 1.6 and then 1.7. Nobody's talking about this anymore. This is like all we talked about for 3 or 4 weeks was the 10-year treasury. Inflation's coming, and the 10-year treasury goes right back down to 1.6. It's not doing anything. I mean, it's like, did everybody's worry just change to something else? It's really mind-boggling how that issue went away. The VIX over here, okay, the VIX at 17.29, up a point, big deal. I've been saying to you, we've got to see going to 20 for a new leg in the rally to go higher. It worked. But now where do we go from here? Do we have to see the VIX go even lower? Do we have to see the VIX go up so we could recharge? The VIX is something that typically the VIX goes up when the market goes down. The VIX, it's an indicator that professional investors, institutional investors are worried about the market, and they're paying more for hedges to protect their portfolio. So if they're nervous, they're buying more hedges to protect their portfolios, the VIX will go up. And the VIX could rocket higher. Like it was up 6% today, but that's nothing unusual. Like if the Dow, NASDAQ, or S&P were up or down 6%, forget about it. I mean, I would, that's all we'd be talking about. But the VIX 6% move is quite ordinary, okay? I'm going to bring you down here to the Russell 2000, all right? Let's take a look at the Russell 2000. So this has not been trading that great on the Russell 2000. I'll take you to a 3-month chart. Not quite the beginning of the year, but the Russell 2000 closed down 30 points, 1.36%. So clearly the biggest loser of the major averages that we follow here on Be the Boss of Your Money. And the Russell 2000, what you need to know is this. It's a index that follows small cap stocks. Okay. And you as you know, you can't, as I say all the time, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index, but it's small cap stocks. And if you go back a year, this is the winner. I mean, look at this 1-year chart. Look how good that is. But the small cap seemed to have peaked about a little bit over a month ago. Okay. And small cap stocks, the thing you need to know is small cap stocks are more sensitive to the economy because small cap companies are generally more sensitive to the economy because they get most of their money, of their revenues domestically. So it's not really a good international indicator. Small caps, you would expect would do very well in a rising bull market. And my interpretation of a weak small cap index, the Russell 2000, my interpretation is that it's like there's a little decay beneath the surface. There's a little crumbling of breadth of stock market action below the surface that you're not really seeing in the Dow Jones Industrial Average or the S&P 500. But I was having a talk with a friend of mine a few days ago, and he says, "What do you see?" I said, "I see some deterioration because, like in 1999 and 2000, in 2000 we had a major peak and the market tanked. The S&P went down about 50%. The NASDAQ went down about 80%. I can't overstate how extraordinary it was to be a financial advisor during that time when the NASDAQ goes down 80% and the S&P goes down 50%. Okay. It was an extraordinary time to be in the business. It was a very difficult time to be in the business also. Okay. So, but what was happening is even late 99, there were a lot of smaller cap tech stocks, internet stocks that were going down, a lot of deterioration, but you didn't see it. Let me get out of that. You didn't see it. So there was a lot of deterioration with the smaller companies. You didn't see it because it was masked by the S&P 500 continuing to go higher. So the money was coming out of the more speculative, third tier, uh, tertiary stocks, and people were just moving that money into the larger cap tech stocks. And that's what was pushing the larger cap tech stocks higher. Money was just being swapped out. And the smaller tertiary, really highly speculative stocks became a source of funds for investors to plow more money into Microsoft, Sun Microsystems, which you may not have ever heard of. It was bought out by Oracle for like $5 a share. And Sun Micro was one of the biggest stocks in the NASDAQ at one time. AOL, Yahoo. Yeah, AOL was like a major tech player at one time. Okay. Believe it or not, AOL was like, excuse me, believe it or not, AOL was like the best real estate on the internet. Now it's like, if you see somebody who has like an AOL at the end of their email, you're like, AOL, like that's ancient, right? Nobody uses that. So, excuse me, I got a little something in my eye. All right. Well, this is live streaming, and you know that stuff happens. It's the beauty of live. You never know what's going to happen, right? So that's what I see: deterioration happening, and the smaller tertiary stocks look like they could become a source, or are a source of funds for investors to buy the larger cap stocks, hence pushing up larger cap stocks until the fuel runs out, and then there's no place left to hide. We have a correction. That is my concern at the moment. It's always a possibility, but I didn't really put that concern on the front burner. To me, it was just like a list of tons of possibilities out there, but I've just taken that off the shelf and put it down here, right in front of me, right front and center, because I think it's a legitimate worry. Okay, so let's take a look at something on the more bullish side. We'll go back to the screen share. Okay, so Tom Lee, a fund strat, says energy stocks could rally another 45%. Hey, I'll take it. Another 45%. As many of you know, I said I put out a video recently, very late last year or early this year. I said I put out two videos. One, I'm very positive on bank stocks and energy stocks. You know, I've been right. I've been right on the money with that. And I think fundamentals still favor both those sectors. I know what you're going to say. You're going to say, well, we're all going to electric cars. Oil demand is going to get crushed. Surface fuel demand is going to get crushed. We'll find other ways to use up the oil. Don't you worry. There's always some other energy hog. I mean, we've got to charge all these batteries, right? We're not going to all electric cars tomorrow. And as oil came down during the pandemic, a lot of energy companies went out of business, and only the strongest companies have survived who've got the lowest cost production. And that's who survived. So it's a very healthy sector to be in. All right. By the way, Deutsche Bank, was it, I think is Deutsche Bank says they see another 5% upside in the S&P 500. I mean, the S&P 500 is over 4,000. And when we ended 2020, seeing the S&P go to 4,000 would have been like a pretty good deal. Market's up, what now, 11% year to date. That's like 11% is a good year. And we're only in like the middle of April. So we've already seen a lot of upside, and I wouldn't be surprised to see a nice little correction. I'll tell you why in a moment. Let's keep going. Okay, so the winners of the day, the 11 sectors, the S&P 500 is divided into 11 sectors according to S&P. One of them is real estate, and I'm just showing you the exchange traded funds, big, well-known ETFs that track each one of the major sectors. So real estate up a drop, healthcare barely up, up 0.02%, and everything else was down. So it was definitely more or less an across the board down day. Okay. Let's look at the FANG stocks. Netflix, whose earnings are coming out tomorrow, and everybody's watching out for that. If any earnings news comes out, by the way, over the next couple of minutes, I'll definitely let you know. IBM just came out with numbers. They beat revenues. They had revenue growth for the first time in ages. Stock popped 4% after market trading. But Netflix, Apple, Google up, Microsoft, Amazon, Facebook down. Given the size of their market caps and how much each was down, it was a pretty even day. So these stocks didn't really take anything away or add anything to the S&P 500. So just wanted to give you a look at that. Okay, so moving right along, 95% of S&P 500 stocks are above their 200 moving day average. That is extraordinary. 31 years in the business. I don't think I've ever, I don't recall a number as high as that ever. More significantly, the NASDAQ has failed to make a high. I mean, you keep hearing how the market's making new highs, but not the NASDAQ, just the S&P and the Dow. So all of a sudden, NASDAQ stocks aren't really doing what we thought they would be doing. So NASDAQ stocks aren't making new highs. In fact, the NASDAQ has been failing to make new highs for a while now. Deutsche Bank says that equity allocations amongst investors is in the 98th percentile, which is sky high. And Bank of America, in a study, said that investors poured more money, retail investors poured more money into stock funds in the first quarter of this year than they have in the last 10 years. And so these are negatives. These are signs of exuberance. These are signs of overly optimistic investors, maybe. But that's what it took to get the market going. And it doesn't mean this ends. And I'm not making a call here. What I want you to do is this. I want you to realize that your buy and sell decisions really need to be a matter of your personal finance. And a lot of people have just let the market rally and they're just kind of watching it, not doing anything and not really being proactive enough. I'm not saying trade yourself to death, like go and trade your account like crazy. I'm not talking proactive, like become an active trader and start trading everything from Bitcoin. I don't know. I can't think of anything sarcastic for once. Okay. So there are some good things in the market too. Investor, we do have a strong economy now. We've had earnings for the banking sector so far are like 38% above analyst expectations, which is huge. And overall, earnings for the last few quarters have exceeded analyst expectations. But when companies exceed analyst expectations, analysts then typically will raise their guidance for the next quarter. And eventually a few quarters go by, and how much more are analysts willing to raise their estimates? Eventually, analysts start to raise their estimates too much, and all of a sudden, companies can't meet analysts' objectives, analysts' expectations, and now stocks start to miss expectations, even if their earnings went up. But if everybody's expecting a company to show 20% earnings growth and 20% revenue growth, and the company shows 10% earnings growth and 10% revenue growth, well, that's still pretty good. Stock could get slammed because it's all about the expectations. So expectations are starting to run very, very high. And I think that's part of the problem with the NASDAQ, and it's definitely part of the problem with the small cap stocks. Banks have still like $2 trillion in excess deposits. There's still plenty of money for lending. I think we're going to have a massive economic inventory manufacturing rebuild because people are buying stuff off of store shelves like crazy because of stimulus money. So that will definitely kick in the manufacturing economy into high gear. Airlines are bringing back pilots. They're bringing back aircraft. They're doing everything they can to get ready for a surge of travel. But eventually the stuff starts to get factored in, and analysts' earnings expectations become so high that companies fail to beat those expectations. And that is what often causes a reversal. So here's what you need to do. You need to, just checking the time here, we're going to be done in like a minute. So here's what you need to do. You need to do a gut check with your personal finance. Don't give me this like, oh, I have a feeling the market's going to go higher, or I have a feeling there's going to be a correction. I can't stand that either way, okay? Usually when you have a feeling, it's the culmination of the most recent information that you've taken in, mixed with your own investor biases. We have to do our best to remove the investor biases and let something else guide us. So I say, let your personal finance needs guide you. So what you need to do is realize that, hey, market's up a lot. Maybe some of my goals are not too far away. Maybe you have financial obligations coming up, and you should really take a look. And if you are getting closer to your financial obligations, don't try to squeeze out every last penny out of the market. Like you're going to be the one who top ticks the market and gets out just in time. Don't take that risk, not with money that you're going to need over the next few years for something that's very important to you. That is the most important thing that I could bring to you when it comes to investing. So that is, I think that's the show for today. Okay. I greatly appreciate you sticking around. On Wednesday, I'm having a guest, Donna Lascala. She is an expert in the field of divorce finance, not financing divorce, but helping people get through a divorce in terms of what they need to know about finances, money, and how that whole process works. It's not something that the lawyers are going to do for you. And I'm looking forward to that because, unfortunately, divorce is a pretty big topic and not too many things impact your finances negatively like divorce. So we're going to get into that on Wednesday, and I will see you tomorrow. We do have some comments and questions. I need to get to those. All right. Josh is out there. Great job. Thank you very much, Josh. Let me put that up on the screen. Thank you very much, buddy. And James is out there just catching the end. You know what? I'm glad you're here, James. Thank you so much. And I look forward to catching your live stream soon, too. All right, guys, I'm going to get going, and I will see you tomorrow. Thank you.